I just want to kind of ask you a question here. If people are promising that you can double your money in a day, doesn't that mean that you'll have to risk the same amount to get that gain? Now, with foreign exchange, it goes hand in hand. Your risk equals your reward. In some cases, your reward is better than your risk, depending on your take profit. But if you're risking 20 pips and you're betting that you're going to get 20 pips, you could very well lose that 20 pip trade. Now, if you're betting half of your account on that one trade and you're hoping to gain 50% on that trade, you lose that trade. Now you're playing with 50% of your entire account. To get back up to your original account size, you have to work twice as hard. The way that the technique of money management that I use, it's a fractal percent type of money management system that works with leveraging weekly or monthly to increase profits, but I do not risk 50% a trade. I don't risk 20% a trade. I risk maximum 2% per trade. And you're going to say, well, these guys are telling me that I can risk my 500 to 1 leverage with my, 20% per trade and double up the next day. Well, the whole idea between trading foreign exchange successfully is consistency. It's not a get-rich quick scheme like many people would have you to believe. These people are actually not even traders at all. You'll see banners, advertisements, all sorts of crazy stuff out there on the internet. They're just marketers trying to take advantage of the boom in the foreign exchange industry. I was actually part of that bubble. 3 or 4 years ago, I got involved in the foreign exchange market, and yeah, I was buying everything from the gurus. I was reading all the PDFs. So don't feel bad if you have done that. I think many of us have, and that's just a stepping stone to get through. But today is where you stop over leveraging your account and over trading and start actually making money. Money management is not boring. People say, oh, well, that's boring. I don't have to worry about that. I have a really good trading system. Well, you might have a really good trading system, or your system could suck. It really doesn't matter. Money management is good for any trading system. If your trading system sucks, it's going to keep you from blowing your account so that you can find that out and then fix your system. If your trading system rocks, you're still going to have losses. So this allows you to be able to recover from your losses. I still have losses. Every professional trader has losses. It's the way the market works. Expect them. And using this system, we expect them. So the way that I do it is I keep it simple. I don't risk more than 2% per trade. If I am going for a scalp, depending on the market flow of the day, so if I look at the daily time frame, the 4-hour time frame, and the scalp is with that particular movement, the trend, I will potentially risk up to 2%. If it is against that trend, I am most likely risking 1%, 0.5% even in some cases. I usually don't risk less than 0.5%, but it all ranges. So again, with the trend, risking more, it just gives me, if I look at a trade and I say, wow, this looks like a really good entry, and it's with the trend, it gives me a opportunity to increase my risk because I have a higher probability of being right. If I'm going against the trend and I'm expecting just a small retracement, I have a higher probability of being wrong. That retracement might be not as deep as I thought it was going to be, or etc. So I'm going to lessen my risk. Now, with risking only 2% per trade, if you get hit, you only lose 2%. So you're still playing with 98% of your account equity. This is very easy to deal with. Now, the way that I do it, I mentioned compounding earlier, is if I'm up, say, 10%, 15% in the week, I will calculate that using the position size calculator that I have in front of me. I will add that to my account size, and then I will change my my lots for the week. But usually I'm changing my lots monthly. Now what this means is I don't worry about leverage. My account offers 50-to-1 leverage. I don't even know what that is. You don't even need to know what that is. I know what that is, but you don't need to know what that is. It doesn't matter. The 50-to-1 is a gimmick. It tells you that you are able to go this far with your account before we call your margin. Now, I don't even want to get close to that. So I'm going to give you an example here of this great position size calculator. I use this every week to figure out my position size for the week. Now, this is important because on Monday or Sunday, if you lose 2% of your account on a trade, you are still trading with the same lots. Do not come back to your position size calculator. If you come back here and you enter your new account size, you are going to be trading with less lots. Therefore, it will be less beneficial to trying to make up that loss. On the contrary, if you are halfway through the week and you are up 10%, I mean, if I'm up halfway, I'm going to go do something else. But if you insist on trading the rest of the week with your 10% profit, do not come back to the position size calculator. If you come back here on Wednesday and you're up 10%, Thursday you're trading with higher, and you could just kill all your profits. It's meant to be weekly and in most cases monthly to change your lot size over. So let's just start with a 1,000 size account. I'm going to risk 2% on this trade. My stop loss, now this is important. Every risk is your stop loss. So it's not going off of what I think I'm going to make or how much leverage I want to spend here. It's specifically designed to calculate your risk on what you could lose, not what you can gain, on what you will lose if you lose the trade. So if I put in 30 pip, which is the max stop I ever use, it calculates how much money I will lose, the units, which is important if you're trading with mini, nano, standard. This will give you your lot size. So if I was trading with my mini account right here, I would basically move the decimal place to 0.67. And I would always round down, so I'm trading with 0.6. Now, doing this protects your account for many reasons, because you could be trading different position sizes. Say you're on the hourly chart or the 4-hour chart, 50. You're scaling down to a 0.4 lot and these are in standard lots. So you'll have to kind of calculate that. But you can see just by looking how much this protects your account. Now, how do you get money from this? I know we're talking about losing money a lot. Well, I go by a nice little rule that is expect to lose first and then take the profits. So I'm expecting to lose. If I expect to lose, this is how much I'm willing to lose. Now, if I win, this is how much I want to win. And it kind of keeps me from being greedy. So instead of saying, oh yeah, look, I'll put my stop loss like this so that I can be able to get this amount of money, I'll say, well, I want to keep my stop loss tight because I want to protect my money. My biggest concern is protecting my account size. The lower the account size gets, the harder it is to increase it. So, always going with the 30 pips. And the way that you can get more than 2% on this trade is obviously if the trade goes higher than 30 pips. So say This trade, and I recommend this on every trade, you don't want to be looking for a 1-to-1 risk-reward ratio unless you're scalping. Scalping with a strategy is usually going to give you a higher percentage of wins, but if you're a trend follower or any other type of system, you're going to be looking for 1.2, 1.5 to 1 to 2, 1 to 3 in some cases risk-reward ratio. Now what I like to do is when I cover my risk, when I cover this 2%, I immediately bring my stop to break even. This just gives me comfort. You don't have to. I like to do it. You're going to get stopped out of some trades that come down, they pass your stop by 10 pips and then shoot up in your direction, but it's going to save you from a lot of losses as well. So when you cover your risk, your 2% risk, 1% risk, whatever you're risking, from your stop loss, I'm 30 pips take profit, I'm going to immediately bring my stop to break even. Now, what I'm going to do is I'm going to scale out of the position. I want to take profit on this trade. I want to take off 30% to 50% of this trade. Even if I think it's going to go for the moon, 150 pips, I want to take out 30%. I want to pay this trade already. Because we could very much likely just come down and stop you out at break even. And it's pretty disheartening to see your trade 30 pips in profit, and then all of a sudden you got nothing. Or a loss, even. And, so this is a psychological thing, and it also helps protect your profits as well, and helps protect your free trades. So this is a free trade now, right? We're at 30 pips, free trade, break even. I took money out. Now I feel really good. Now it's easier for me to manage this trade, because everything's not on the line. Nothing's on the line. So that's just how I manage a trade while it's in there. But to give you an example of the profit actually margin in this, if you're scalping, if you're just scalping, we're not even talking position trading or swing trading here. If you're just scalping 2% and you get 2 trades a week, I know everybody wants 5 trades a day. Well, it's not going to happen. Max 2 trades a day I get, or I take. The more trades you take, the less probability they have to work out. The market's not going to just hand you amazing probability setups constantly. So you need to take and cherry pick your setups. I have this as my background to my computer. It says 20 pips a day is 100 pips a week, is 6% plus weekly. And this is just going off of my 30 pip rule, 2%. So 24% monthly. That's monthly, and that's compounding. I urge you to take those figures and put those into an Excel spreadsheet and do a little macro in there and see what you can get at the end of the year if you start with a $5,000 account. I believe it'll be somewhere up of $70,000, some number like that. And then from there, if you trade that for another year and you just get 16% a month, you just get that, it'll be up to I think it's $600,000. So people have a hard time realizing that. They want to overtrade. They want to trade 4 times a day. Don't do it. Cherry pick your setups. High probability equals success. If you don't cherry pick your setups, you're going to get stopped out a lot. You're going to give your 16% back. You'll give it right back to the market. I guarantee you. We're all going to have losing trades, but if you cherry pick your setups, you're going to have a high probability and you will have high percentage. If you risk management and you only risk 1 to 2% per trade, depending on your stop loss, and you use the Forex calculator that I showed you, weekly or monthly, and you compound, don't take any money out of the account, you will be successful.